and welcome. This is not Indianomics. We would rather call it The Name is Bond. And I'll tell you why. June 28 is an important day for India's bond markets, for rupee, interest rates, and indeed the Indian economy. Starting June 28, Indian government bonds enter JPM's Global Bond Index for Emerging Markets, or GBIEM as they are called. Indian bonds are to have a weight of 10% in the index. The inclusion will, however, be phased out, with 1% weight getting added every month until the full weight of 10% is reached in March 2025. In addition, Indian bonds also enter the Bloomberg Local Currency Bond Index, which will see a flow of about $3 to $4 billion next year. The start date is January 2025. These index inclusions are likely to have far-reaching impact. $35 billion or nearly 3 trillion rupees of Indian bonds could be bought in a space of a little over 1 year. Dollars have rushed in and will continue to. Government borrowing cost could fall. So will that of corporates, perhaps. Some of this has perhaps already happened. $10 billion, we are told, have already come in ahead of the index inclusion. And we have seen, of course, Indian yields fall a bit since last September. Going forward, how does the grammar of markets and of the Indian economy change? To understand this, I have with me an elite panel. Kenneth Akintewe, the head of Asian sovereign debt at Abrdn Investments, Samiran, Chakraborty, chief economist of Citi India, and Kaushik, chief economist, Deutsche India. Gentlemen, thank you very much indeed for your time. Kenneth, you will find more questions coming your way simply because you represent the buying community and the market expert. So first up, what should we expect next week, post June 28? Can there be big movement in terms of inflows, or will it be more like business as usual?
So there's a few things going on. First of all, hi to you and the fellow panelists. There's a lot of things going on at the moment. First of all, for a lot of these new investors that will be coming into the India markets, before they can buy bonds in India, they obviously need to register as FPIs. And while this process has improved, some maybe are still struggling with it. So there may be actually some investors who are not yet ready to access the market, which means that their flows may be drawn out a little bit later. But we're clearly seeing a pickup in flows. The data over the last 2 months has been quite clear. It looks like June is going to be a strong month for FPI bond flows. And so the expectation is that as more and more of these new FPIs get registered, we will begin to see those flows picking up more strongly over the coming months. Another thing that is pretty important has been the performance of the India bond market relative to the rest of the local currency market. Obviously, it's been a very challenging year this year. It's not just India going through elections. Many of the emerging market economies are going through elections as well. And in those cases, many of those cases, they have, like in Mexico, they haven't gone so well. And there's a tremendous amount of market volatility happening in the rest of the EM basket. So performance of the other emerging market, local currency markets hasn't been great this year. That is probably going to encourage investment managers managing local currency funds to want to allocate more into India. So it may not be just a case of building indexed inclusions. They may actually want to get ahead of the 1% a month and build a bigger position in India. So that could encourage stronger flows to come into the bond markets as well.
Okay. Well, Kenneth, to persist with this point, the mechanics of the market, I heard 2 points of view. One, that investors into Indian bonds will still prefer the non-government bond route. That is, they'll go through the TRS route or through Supra bonds. Is that right? And that this will not be necessarily the most attractive way to take an India exposure? Or the other thing I hear is not just the people who follow the GBIEM index, but even other active funds will actually realize that, oh, India is in the index, so it's worth taking an exposure. Which is the correct explanation?
It probably lies somewhere in between. The supranational bond market does have advantages. So first of all, yields have been trading in line with the domestic bond market, but you don't pay tax on those bonds. So on a net of tax basis, it's quite an attractive market. Here's the issue, though. It's nowhere near as big as the domestic bond market. You just haven't got the liquidity. So if you suddenly need a whole host, there's about $300 billion or more that track the GBIEM index alone, let alone the other global investors who maybe want to access the market. The supranational market is not big enough to accommodate all those flows. The other thing is that market hasn't been tested out. So one of the advantages of buying domestic Indian bonds is the fact that foreign investors honestly don't matter. Even once you go through this index inclusion, we will still basically not matter in the scheme of the overall market. It's a $1.5 trillion government bond market, right? So the tens of billions of dollars that are going in largely passive allocations, this is about, a large part of the money that will go in is simply tracking an index, so it won't necessarily be actively traded. So in terms of the active flow, it's not really going to have a meaningful impact on the overall market. By far, the most important investors are the domestic investors, the domestic banks, insurance companies. They are the ones that drive the stability and performance of this market. And when we sell, we get to sell to the LICs and the onshore banks. Okay. Supranational, that market is very different. It's basically only foreign investors that are going to own that market. And so if there's some kind of shock that causes foreign investors to want to reduce risk, it's possible that those supranational bonds will also be included in the assets that need to get sold, and liquidity could disappear very quickly. So from a risk management perspective, you'd want to be careful about how much you put in supranational debt. For all those benefits that we get from investing in Indian bonds, the low volatility, the low correlation to other asset classes, the reasons that it makes it such a great diversifier in a global bond portfolio, you really need to be having a healthy allocation to the actual domestic bond market.
Okay, get that. Actually, you answered partly my next question, which was, what makes India attractive to you, irrespective of the bond inclusion. So I'll come to you for your other, foreign fund perception of India. But let me come to Samiran and Kaushik next. Samiran, do you see this as a big structural move? One big investor coming in, global recognition. What can this mean that even the corporate bond market gets a leg up? What are the structural changes?
So, Latha, to start with, we have to understand that India is still a capital deficient country. Our saving investment balance is such that we have more investment than savings, which means any form of foreign capital is welcome. And in the pecking order of that, we have typically favored FDI and FPI flows into equity, and somehow thought that FPI flows into bonds is quote unquote a bad thing. Now that perception is changing, and we are finding another avenue to fund this saving investment gap, which technically should mean that structurally we should be looking at a lower interest rate to bridge this saving investment gap. The second macro advantage over the longer term is that this induces a certain amount of fiscal discipline, because now you are not just funding your fiscal deficit through the captive buyers of banks and insurance companies, etc., who are almost forced to buy these bonds, but also the foreign investors who would be very closely scrutinizing every bit of the fiscal data. So that fiscal discipline is also, to me, a very important structural positive. And the third one is that a whole new set of investors, in some sense, when it starts looking at India closely, India's position in the global market itself gets much more elevated. So there are a lot of these rub-on effects on investment from other geographies. We are already noticing that some of the geographies from which we did not used to receive that much of inflows are inquiring about India a lot more. Once you are part of that index, then you are not really someone which is an entity which people have not known about. Now everybody will be researching India, and that itself, apart from the passive inflow part, could bring in a lot more of the active inflows, not just for bonds, but even for equities.
Okay. Oh, that's good to hear, because that makes it a more medium-term story, maybe long-term story. Kaushik, let me come back to the markets. Should we expect this event and the more ecosystem impact that both Kenneth and Samiran are talking about getting noticed, India getting noticed, becoming attractive? Do you think this helps bond yields? Do you have a view that yields will come down? If yes, to what? Likewise, the rupee, do you see it appreciating because of a possible reception of more flows?
So, Latha, I agree to all the points that Ken and Samiran made. And I think it's a big shift in the way domestic bond markets will kind of behave going forward in the next several years. And my view is this is not the last index inclusion that India will see. I think there will be more index inclusion taking place. Barclays, Bloomberg, Global Ag at some point of time will probably include India, and this will have further legs. It's not just a one financial year story and over. So I think over the next 4 or 5 years, you'll see a lot of flows coming into Indian bond markets. And as it happens, the demand side of the bond dynamic improves quite a lot. And on the supply side, we know that the government is very, serious about fiscal consolidation, and they probably would keep on reducing the fiscal deficit lower and lower, and that will control the supply of bonds. So the demand supply dynamic of bonds would improve, not just for this year, which has already happened, but going forward also that positive dynamic will remain. And if you think of it on the margin, bond yields have already reflected part of that improvement. 10-year bond yields today are sitting below 7%. This is at a time when US treasuries are still on the higher side, but still 10-year bond yields have come below 7%. Now the question is, whether it will go down quickly to maybe 675, 680, probably that will not happen, because for that to happen, you need another lever to take place, which is basically RBI monetary policy or expectations of rate cuts have to be there or brought forward for bond yields to kind of react positively. So at this stage, I think you are kind of at the fair level, maybe a little bit of more downside possible for bond yields, but the next trigger would be more in the form of the budget. We're expecting about, say, 5% fiscal deficit for this financial year. In the interim budget, they are given 5.1% fiscal deficit target. We think it can be better. But if it is better than 5%, somewhere around 4.9 or something like that, then bond yields can react positively and can fall even more. But one thing you should remember that we are expecting about 2.5 billion kind of flows every month because of the bond index inclusion. And if you think of it, every week we have about 4 billion kind of auctions that take place. So in the bigger scheme of things, you're going to have 2.5 billion of inflows from foreign investors, but about 16 billion of auctions that happen each month. So it's not going to change or reduce bond yields drastically or quickly, but over a period of time, as Ken said, as the flows keep on accumulating and people show more interest in India, on the margin, definitely the cost of capital would reduce and the financial repression on the banks will reduce. So it's a very, very healthy development in my view. And even after this inclusion, India's foreign investors holding of local currency bonds probably would go up to 4%. So it will still be a domestic-oriented fixed income market. But on the margin, definitely price discovery will take place and bond yields are probably going to be lower from where we are 6 months or 9 months down the line.
Got it. Actually, I must ask my director to bring up that table since all of you are alluding to it. Indian banks, the government bond ownership structure, if we can get that table, Indian banks own 40%, insurance 28%, Reserve Bank 13%, pension funds 5%, foreign investors 3% as of now. And as you all say, probably it may go up to 4 or 5%. Very quickly, one question before I take the break. Ken, what's your view of the rupee? Do you see it appreciating? In 2024.
Yeah, the rupee is like the most important, at least for a foreign investor, the characteristics of the rupee is one of the most important things when thinking about investing in the market. And that is because in most local currency markets, not just in EM, but developed markets as well, currency risk is typically what gets you into a lot of trouble. So you can see the depreciation pressure now on the euro, certainly in terms of EM currencies, the Mexican peso, South African rand, and so on. So even when you have high yields, it's very easy for currency depreciation to wipe those yields out. So for the rupee, we don't actually need it to necessarily appreciate strongly. We just need it to be stable. Because what happens is in a risk-off environment, when you're experiencing a lot of volatility in other markets and other currencies are selling off, the rupee is stable. And so it allows you to still earn the income from the underlying bonds without having that income eroded by currency depreciation. And bearing in mind as well, many investors into the Indian bond market, they're not going to be coming from base currencies that's US dollars. It could be like where I am in Singapore, Singapore dollars, or European investors with the euro. And this trade, the investment into the Indian bond market, typically works even better against those currencies. You know, the euro depreciating against India means European investors actually make a currency gain on top of 7% yields. So all the strong fundamental structural characteristics, the smaller current account deficit, pretty resilient foreign direct investment, inflows, very strong equity performance, all these things that are supporting the rupee on top of the $650+ billion that the Reserve Bank of India has, which many other central banks around the world don't have, that they can use to defend the currency. This puts the rupee in a very, very strong position. But again, I don't say strong position necessarily expecting strong appreciation. To be honest, we think this year against the dollar, it will be relatively flat, but that means it could perform quite well against other currencies in EM and G10.
Oh, that's most useful for investors who are listening to it. I think the way you have described the performance of the Reserve Bank and the Indian rupee, the Indian government may give you a Padma Award for this. Gentlemen, please hold on. We have many more questions for you, especially in terms of the structural changes and the attitude to India. Back in a jiffy.